Hello guys, welcome back to Global SMC Forex Trading. I hope you are having a beautiful weekdays for Forex Trading. Since you're going to finish this session or this week, Forex Trading tomorrow, which is Friday. So today I've decided to tell you guys what we mean by imbalance in smart money. For this video, I'm just going to take like 10 minutes of your time, guys. If I spend much more than 10 minutes, you just cut off this video. It's just 10 minutes, right? Because you have to know this. If you don't know this, which means you are not doing smart money concept. So what do you mean by smart money concept, right? As you know, guys, here on this channel, we do our 3-step strategy that we use to always view the market every time. To those who doesn't know about it, just go on other channels and see. So briefly, let me just explain it here. When the market is moving, right, we are saying it first does what you call a market structure, right? When it does a market structure, right, it comes to any supply or any demand which is there to fill that demand zone. For this case, here is the demand zone. Then it comes to this demand zone. After it comes to this demand zone, then we use any confirmation strategy that we know. After using that confirmation strategy that you know, then we involve ourselves as the trade is going wherever it's going. Then after the trading, or after we enter the trade, then we use our management system that I'm going to talk about in future, right? This is how we do our 3-step strategy. If you don't know much about it, just go and check our other channels. So what do you mean by imbalance in Forex trading or in smart money, right? We are saying as the candlestick. So just assume that this right here, this one is an uptrend, right? This is an uptrend. Let me write it. Let me not write it. Let me just leave it like this. This is an uptrend. Just see the arrows. Then this one is a what? Is a downtrend, right? So what you're supposed to know now is that whenever the market is moving, or when the institution is moving the market, who are the institution? The main part in the bank, right? The ones that moves these forex candlesticks, right? So you're going to see that for you to see what's called an imbalance. An imbalance, you're saying, as the market is moving, or when it's moving to wherever it wants to move, it's supposed to come and feel that imbalance before it decides to go to any direction. So you're going to see that imbalances, right? For people who knows, there are a lot of ways that people like to use, right? With this concept, we have what you call an imbalance, a fair value gap, fair value gap, fair value gap, right? A fair value gap, a fair value gap, right? And mitigation and mitigation. So for this case, it's unmitigation, right? And mitigation, right? So if I think most of you are familiar with this called like words, but they just mean the same. It's just that people like to use their fancy words, but they just mean the same. Imbalance, not imbalance, right? Imbalance like this, right? So what are we saying now, guys? How do you use them, or how do we see them, right? When the market is in an uptrend, right? I know that, guys, you know these are just assumed as candlestick, right? You're going to see that you check the sticks, the first 3 sticks that are there, the first 3 candlesticks are the one that you check, right? So what are we saying? If you check here, this is the last stick that you have here, which is this one, right? If you check this one and the third one here, the last one, you check this one, right? You're going to see that there is a gap that we see here, right? Then again, if you check this one again, this first one and this last one, or the third one, right, you're going to see that this one and this one again here, right? So now how do we identify the imbalance now? So if you check from here to here, right, there is a space that is left between these 2 candlesticks, right, which is the one that I've drawn here. There's a space that is left between these 2 candlesticks, right? This is what we call imbalance, right? This is what we call imbalance, right? So every time that I'm going to be drawing about imbalance, if you see any yellow zone, it means an imbalance. So if you check again here, these first 3 candlestick, 1 2 3, this tick and this tick, you can see that they've crossed over. You understand? They have crossed over, which means there is no imbalance. Let me make this red. There is no imbalance, or the zone you have been mitigated. We say the zones you have been mitigated. The zones have been mitigated, or the zones have been filled. So I know you guys will be like, oh, so you're telling us about this. Well, how do you use it now? So what do you use it for, right? Or what does it mean? We assume that when the market is moving, right? When the market is moving, right? Let me draw it here. When the market is moving, right? We assume that when the market is moving like this, right? Maybe the market is moving something like this, right? We assume that everywhere that we leave those gaps, right? Let's say the gap is here. We assume that the market is supposed to come and fill, either it's going to fill and goes up, or even to cross over it. But we assume that every time that we see an unmitigation or a fair value gap, right, the market is supposed to come to that zone and fills that zone before it decides to go everywhere or anywhere that it goes. But it doesn't mean that every time that you see this fair value gap, the market is supposed to come. No, but most probable that's what the market is supposed to do. To those who have tried and tested it, I think you can even tell me that most of the time, like 70%, that's what happens, right? So when the market, or when the candlesticks are mitigated like this, right, we assume that the orders have been filled, right, with the what institution. So which means the market can continue to go wherever it wants to go. But whenever it moves, or whenever it leaves an imbalance like this, or these gaps that we see here, if we use our ghost feed or the fake candlestick like these ones, we assume that the market is supposed to come and tap before it goes to any direction that it wants to go, or maybe to come and even go down wherever it wants to go. But most probable, the institution is supposed to come and fill these orders that are left to this imbalance. This is how we use the imbalance. So you're going to see that the whole of smart money is more of imbalances that you will be applying, because you can't tell that what you're supposed to do only, but when you check these mitigations or imbalances, then you can see, right? So I have explained this on what, on the uptrend, right? Let me explain this again on the what, on the downtrend. So for in case you want to know what I was writing here, guys, you can just rewind the video and know what I was talking about. So remember, when I use yellow means what, imbalance, then red means mitigation. So what are we saying here, guys? So we are saying here, if we check this candle, right, let me draw another one here, guys, so that it makes sense to you guys. I want everything to just make sense to you, so that when you go back to your forex trading, you're just going to milk the market. You understand? You're supposed to be milking this market, right? So let's assume the same concept that you're using, guys. The same concept that you're using. Okay, so here I'm just telling you guys this for educational purposes. I'm going to show you the exact thing, like the one example on the real market. So what are we saying? We have 1, 2, 3 candlesticks, right? This is the last one, this stick that you're seeing here, and this one of the third one. We can see of this third one, we can see that they have crossed over, right? So what did we say, guys? If you still remember, whenever it crosses, right, it means what? The zone have been filled, right? Yes, the zone have been filled, or it have been mitigated. So the market is not supposed to come, but it doesn't mean that it doesn't come. No, it will come, but most probable it does not come, right? If we go again on this one, right, you just choose any zone that you want. Here, the first one, and this one, right? You can see, guys, that there is a yellow zone, or the gap that the market have left here. So this one, we said it's a yellow, the yellow zone. The yellow zone means imbalance. The red zone means what? Mitigation. So we assume that, let's say the market is going down, right? So we assume that, let's say the market is going down, whenever it's going down, right? We just assume that the market most probably is supposed to come to fill this gap before it decides to go down or decides to go up, but it's high probable that the market is supposed to do that. So guys, this is how you just use the imbalance. So the imbalance just shows you or gives you a guideline of knowing what you're supposed to do at that particular time. You understand? This is how you use the imbalance. So let me just go on the real chart and show you how you use them on the real chart. This is Forex trading, guys. If you just master this concept, you're going to change yourself, the way how you even view the market. So let me just take from here. Let me just take from this zone up to which one? Up to this zone, right? I just want to take from this range, right? So what were we saying, guys? Right? This one, let's take the first one, the blue one. You see this, guys? The blue one and the third one, right? You've seen that this first one and the what? And the last one here is filled, right? This one, let me highlight it. This one and this one again, right? You're seeing this, right? Is filled, right? So most probable, what are we saying now? If the zone is filled, right, the market, right, there's no way, or it's not supposed to be coming to this zone, right? But if you go on this one again, the red one and the one which is on the third one, you can see that we have an imbalance, which is here, from here to here, from here to here, right? I hope you're following, guys. This one, let me highlight it. So this one we called it red, this one should be red, right? Then here you can see that from here to here, guys, is yellow. We said an imbalance, right? If you go again on this red candlestick and this third one, we can see the same again, guys, here and what, and here, right? You are seeing, right, here, right? We have a zone that you are living here. So all these yellow zones, those are called the what? The imbalance. So you're going to see that as the market goes down, right, you're seeing that the market came again to fill these what? These zones, until maybe it wants to fill some zones maybe which are here, or maybe it wants to continue to fill all these zones. We don't know, but we just know that most probable the market is going to come and what? And fill those zones. That's why you saw the market coming back again to fill those orders. So this is how we view the market using the imbalance. So if you know the imbalances, or if you know how to use them, you're going to see that the way how you view the market in terms of imbalance and trading, you know how to use them, and you make your system to be profitable, right? So guys, I think this is what you're supposed to know in 10 minutes. I just explained everything in 10 minutes. This is what you're supposed to know. So for the sake of recap, let me just recap everything that I was just saying for the extra 2 minutes that you have given me, because I said 10 minutes, but I think it's more than 10 minutes. So extra 2 minutes to just explain everything, because at the end of the day, you just want to know what you're supposed to do, right? So what were we saying? We're just saying you just check the first 3 candles, right? So if you check this first 1, 2, 3 candlestick, then you check this 1, 2 sticks that are here. If they are crossed over, it means the zone have been mitigated, or it have been filled, right? So the market most probably is not supposed to come there. But if you see a gap that is between the 1, 2, 3 candlestick, it means that the market most probable is supposed to come to that zone, right? This is how you view the imbalances in smart money. So guys, thank you for your time, thank you for listening. So I think I'm going to do another video. I'll choose the next topic. Maybe I'm going to talk about how we refine the supply and demand zones to involve ourselves in forex trading, right? So guys, don't give up with forex trading. Forex trading just a system. Just make your system that you understand. Try it at least 3 months. Try your system at least 3 months until you are confident enough with it. Then you start to become profitable. Thank you for listening attentively. This is Global SMC Forex Trading. We're talking about imbalance in smart money. I'm signing out. Thank you.